begin this journey today with the first session of this series. It is my privilege to introduce today's speaker, CA Rishabh Gujarathi, sir. Uh, Sir is a seasoned transaction and regulatory advisory professional with over 13 years of experience in mergers and acquisitions, corporate restructuring, FEMA, taxation, RERA, and valuations. Having worked with leading firms including BDO, Catalyst Advisors, he has advised startups, family businesses, HNIs, multinational corporations, and listed companies on complex domestic and cross-border transactions. He is currently the co-founder of eAdvisor, a platform connecting businesses with expert professionals across finance, tax, legal, and regulatory domains. We are delighted to have him with us today, and I am sure his insights and practical experience will make this an enriching session for all of us. With further ado, I invite CA Rishabh Gujarathi to take over the session. Over to you, sir.
Welcome, sir.
Thank you, Shubham. Thank you, Abhijit, for the quick introduction, and thank you, ICAI Nashik, for inviting me to speak on this topic. Um, the topic is very complex. The topic is there are many uncertainties in this topic, but we have the whatever I speak will come probably out of some experience in handling it, and we are always 50 to 60% short of what we know about this topic. So anyone who practices in FEMA, he is always 50 to 60% short of what is happening because things are so uncertain. There are n number of circulars, there are n number of notifications. Some notifications are provided by RBI to AD Bank, and we are not aware of it. And there are multiple practical challenges that arise because of this. Let's say, for example, if you are doing overseas transaction, there is a condition where you need to have at least 6 months prior valuation report, right? Now this valuation report and this condition is given just by RBI to the AD Bank, which AD Bank keeps it in their file and checks it. But we get to know only when we go to them to undertake the transaction. So there are multiple things like that in this domain. But let's try to get into a high level overview of what it is. And then, as Shubham mentioned, that we are going to have a series of discussions. So probably we can go deeper and deeper in whichever sector or in whichever topic we want to get into. Starting with, let's start about so today's topic probably is current account transactions, and again this is a very wide topic. It includes trade, it includes liberalized remittance schemes where individuals send money abroad, probably for their children settling abroad, probably for their children going out for studies, probably for their parents who are living outside, medical expenses being sent here, tourism where people travel outside and they need to spend some money there. So all these transactions are currently part of a current account transaction framework of FEMA. But if you see the majority of the chunk, and I'll explain it in the subsequent slides here, a majority of chunk of this current account transaction is handled into or is taken care by the export and import directions, because around 90% of the India's current account transactions are of trade, and the trade includes export and import of goods and services. So there is a lot to think about and there is a lot to discuss about current account transactions, but let's discuss export and import today. And then we can go much deeper into these topics because I'm sure we being professionals deal with these transactions mostly. Of course, there will be professionals who are also working on individual side where LRS and all these limits are to be taken care of. But these these export and import directions, I think, are very critical to understand. Hello.
Yes, sir. Hi.
Yeah. Uh, Sorry, I think my
Just
network was
start with the slideshow, I think. Start with the slideshow, and as you will change the slides, automatically it will get reflected.
okay. Can you see now?
Yes, yes.
Let me do that again.
Again, I think you need to share that.
Can you see it now?
Yes.
Yes. Yeah. So the whole idea of talking about this was, let's get into import and export first, and then we'll get more deeper into another angle of current account transactions. So let's try to understand what is exactly current account transaction from FEMA perspective. So basically, FEMA is divided between current account and capital account. What is capital account? Wherein, let's say, for example, I being a resident individual or a resident company, if my assets and liabilities position has been changing across the border, it's a capital account transaction. Or if I'm a non-resident or a foreign company and my asset liability position is changing in India, then it's a capital account transaction. So let's say, for example, if I'm buying certain shares of a company which is a private company in US, probably that is because of overseas investment which I'm doing. It's a capital account transaction because that is changing my asset and liability position across. However, if I am buying, let's say, capital goods or machinery, which which is used for my business here in India, and I am importing that, that is not a capital account transaction, because even if it is changing your asset and liability position, it is not actually changing your asset liability position across the border. So whatever transactions are in the form of cross borders and changing your asset liability are capital account transactions, and whatever is not a capital account transaction is current account transaction. So that's how current account transaction is actually also defined in the act. Coming to what is permitted and what is not, capital account is strictly not permitted, it is restricted. Now they have given certain positive list, like investments outside India in a company and FDI in India from a multinational company across. These kind of transactions are specifically permitted into FEMA regulations, and that's why they are allowed. Any other capital account transaction is not allowed, and there is a clear inverse logic for current account transactions. All kind of current account transactions are permitted except otherwise prohibited or restricted. Now, how is this regulated? This is regulated by FEMA Act, which is Foreign Exchange Act 1999. Current account transaction rules 2000. FEMA 23R regulations. There are multiple regulations from import side, export side. There are multiple circulars, but everything fortunately is combined for us into master directions. And that's why we'll take that as a base whenever we discuss on the current account transactions. So I am considering master direction 16 and 17, which is for export and import. And you will also see in the subsequent slides, there is a regime change which is coming up. This entire thing will again be consolidated into one master directions from 1st October 2026. So I think fortunately we are talking at the right point of time where we will be probably in a transition phase from legacy export and import directions to one consolidated direction, and there are some substantial changes in the rules as well. Moving forward, current account transactions are basically into three lists, which is Schedule 1 list, which is something like lottery winnings, tickets, and racing or riding income, which is completely prohibited, absolute bar. There is no way we can undertake these kind of transactions cross border. There is a list which is in Schedule 2, which requires sector-based government approval. Now, this may include something like cultural tours, print media, where you need specific sector approval from our ministry or department or government to conduct these kind of transactions. Schedule 3 is basically gives RBI power to approve certain kind of transactions. Now, let's say, for example, we need to do a liberalized remittance scheme, remittance, outward remittance of US dollar more than 250,000. That is completely allowed between in current account transactions. But if you have to go beyond, you will have to go to RBI to get their specific approval on the specific transaction. So things like that, wherever there are certain limits which has been provided, and we need to go beyond because of reasonable and uh, commercially expedient reasons. RBI, you can approach RBI, and RBI will have to give you a specific approval for that, and only then you can do it. Otherwise, you can't. Now, practically, one more thing here. We as a citizen or applicant cannot go directly to RBI for current account or capital account transactions. We need to go to our AD bank. We need to choose them wisely. Who is going to be our AD bank? When I say AD bank, it could be any bank through which we are going to do a cross-border transaction. HDFC, ICICI, SBI. It can be anyone. We have to apply to them, and they take our application together with us to RBI. So there is no direct route to RBI. We have to go through them in all the cases. Now, one question that remains is classification so much important? Let's say, for example, I am making any kind of remittance. Is it a current account transaction or a capital account transaction? Till the time it is permitted and is going outside, does it make sense to, trying to understand what is capital and current? Uh, Honestly, it does, because there are certain definitions, certain documentation, certain approvals, and certain level of penalties for a current account which are not there for capital, and vice versa. So whenever we deal with any kind of transaction, it is critical to understand which category we fall in, and then we get deeper into, okay, if this is allowed, then let's see beyond this, under which regulation or under which circular we fall. Talking about trade, because that is going to be our point of discussion today. As I said, around 90% of our current account transactions is into trade. And for us, there are four torch bearers in our language. One is DGFT, which creates the entire foreign trade policy of what can be imported, what cannot be imported, where to levy anti-dumping, which what are restricted, where do you need a specific license, what is the positive list, what is the negative list. The entire foreign trade policy, which DPIT issues, is given by DGFT. Now, that is what DGFT does. Second is customs or SEZ. Let's say, for example, any business doing any kind of export needs to do certain kind of documentation, and that what documentation should be done is governed by customs. If you are doing through a SEZ, it's done by a SEZ development commissioner. So what kind of documentation needs to be maintained, how it is to be maintained, is governed by customs and SEZ. AD bank is the one who is the most responsible person in this entire value chain, because they handle our money, what money goes in, what money goes out, what kind of documentation is in place, what kind of KYC is in place. Uh, for any kind of inbound or outbound remittance, they do check who is the remitter, who is the beneficiary, their KYC, their anti-money laundering regulations are in place, and the entire thing is what AD Bank does. And they also regulate or govern this under the guidance of RBI. RBI is the one who frames the policy for the purpose of this entire ecosystem. So consider that this FEMA is a traffic system um, which is regulated by AD Bank and supervised by RBI. That is how it does for our all the financial transactions. Now, how do they monitor it? We need to understand these three topics, or these three backbones of this digital monitoring in very detail, and it is very important for everyone. Either we be a consulting professional, or be a professional who is working for any organization. First thing is EDPMS. What is EDPMS? It's a export data processing and monitoring system. And as the name suggests, any kind of export of goods, of services, for any kind of advance given, any kind of advance taken, uh, everything comes under EDPMS for export. Let's say, for example, you have received an advance for an export which you need to do 2 months down the line. AD Bank creates your entry into the EDPS system. EDPMS basically is a ledger, which is a ledger maintained between the bank and RBI, to show that, okay, this is the party, and this party is has received advance for the purpose of export, and that export is going to be done, let's say 2-3 months down the line, and these are the conditions. Again, whenever you do the export, that export is again reflected in the system so that that ledger gets closed. Now, closing of that ledger is very important for AD Bank, and that's why they take all the efforts to do it. Whenever they are not able to do it, they report it directly to RBI. Similar is for IDPMS. IDPMS is for import, whereas ADPMS for export. What is fetters? I'm sure a lot of us you would have known, wherever we are doing a outward remittance or an inward remittance, banks generally ask for purpose code. So that purpose code is the entry which fetters, records under which purpose code the money is coming in and under which purpose code the money is going out. This is required for us from our balance of payments and budgeting perspective from the India level. So fetters is still just AD Bank's responsibility, but we, as the doer of transaction, we are responsible for ADPMS and IDPMS. When I'm saying we, it's the person who is doing the transaction. If we are a consulting or auditing professional, there are certain liabilities which come to us as auditor as well, which we'll talk about later. So, and why it is critical? Whenever, let's say 3 months or every 3 months, AD Bank has to report to RBI what all entries are still pending in EDPMS, IDPMS. If these entries are still pending 3 months and 6 months down the line, these are red flag, and notices are issued by AD banks to the customers to close this. Even if, and we as transaction do generally avoid emails from banks and notices from banks, but I've seen enforcement directorate directly coming to us with their notices and calling us with the information. So you may ask, why is ED coming up here? Because RBI doesn't have the machinery to regulate or to ask questions and get the information and get that done. They just are involved into policy making. But these powers have been delegated by RBI to ED, wherein they undertake this entire thing to see, if there are any exports and the money has not come. So is there a money laundering issue or a trigger which needs to be taken care of? If there is an import advance which has been given and the goods have not come in, is there a money laundering trigger again? So all these kind of transactions are basically overlooked by ED once ED banks has reported it further. So it is very critical for us to ensure that EDPMS, IDPMS is closed. As an auditor or as a consultant, we often overlook this part because this is maintained by the banks, and generally transaction doers are not aware of this at all. But this is the criticality of the matter here. So going further on the export and import front, let's talk about this in two parts. One is trade of goods and trade of services. A lot of it is common in between, but from divided between two things. Uh, Whenever you are doing any kind of export, uh, let's start with the export one. Whenever you are doing any kind of export, you need to declare. Now, how do you need to declare? There are 2-3 frameworks here. Wherever goods have been exported, you need to declare it into EDF. Now, this EDF is also often overlooked because it's generally not a separate form which is to be filled, but it's part of the shipping bill whenever the goods are exported from our country. It's generally a electronic data exchange where this data is put in. And why this is overlooked? Because it's just a small tick mark which is to be done. People just do it and that's it. But certainly exporting the Mr. Angel Can you hear me now? Shubham?
Yes, sir, you are audible now.
Yeah, so we were talking about declaration of exports. Basically, it's done by EDF. It's called as export declaration form. Now there is no specific form as such, but it is just a tick mark which is done at the time of shipping bill, and it generally captures all the details of the transaction, right? What kind of export, the quantity details, and who is the payer, who is the beneficiary, all these things. This is often overlooked because this is not a separate form as such. But let's say, for example, you are exporting the goods to Mr. X in Germany, and you'll be getting payment for this from Mr. Y in Germany. This needs to be reported into EDF. If that is not reported, there is a mismatch which comes at the time of EDPMS ledger, which ED Bank maintains, and that mismatch may create a ruckus, and that ruckus can go up and travel up to RBI and to ED as well. So it is important that EDF and shipping bill captures the entire details. Similarly, for software, there is a Softex forms. EDF doesn't govern software as of now. Softex forms need to be filed. Now, of course, because it's software, it is not regulated on the border. It goes digitally, but there are certain declarations which Softex forms requires to be undertaken. That needs to be taken care of. We need to ensure that full export value is declared, even wherever the value is not ascertainable. We ensure that value is expected on sale and it aligns with the pricing of the international markets. That is critical. Third party export payments are permitted subject to certain conditions. The conditions could be irrevocable order or tripartite agreement, etc. So these details need to be part of your declarations, right? uh, Now, what are the exemptions? Are there exemptions for EDF? Yeah, so there are things like certain trade samples which are taken, or you have taken some of your product outside for publicity in let's say, in some kind of um, uh, what do you say, a summit or an investment summit, wherever you need to show your product. Some personal effects of travelers, gift of goods up to 5 lakhs in value. These kind of products are given exemption, where reasonably, it's technically not a export, but still you need to take the goods out of India. So there are certain regulations for that as well. So for us, we need to ensure that 100% of the shipping bill data is gone into EDPMS, because that will create a mismatch. And it needs to be reported in a freely convertible currency. Now, since October 2022, they have also come up with a regulation wherein you can report that in INR as well. That regulations are still coming up. I think from 1st October 2026, it will be much liberal and people will start doing the transactions in INR. So that is what is expected with the current government. Going further, the most critical part of this value chain is the realization period. Wherever we are doing any kind of export, it is critical that we realize the money within the time limit which is prescribed. If not, it goes into caution listing. Now, what is the issue in caution listing? Caution listing is where AD Bank report to RBI that this exporter has exported the goods but has not realized it in time, and therefore it should be caution listed. If you're caution listed, any kind of your future cross border transactions will probably need either advance payment of the entire export value, which is commercially not viable, of course, and or it may need a irrevocable guarantee letter from your bank saying that, okay, if this is not realized within time, the bank will pay it. So it becomes a little critical to ensure that realization is in time. Now, what is the realization time for us? It has been changing in the last 12 months. Up to 13th November 2025, it was 9 months. From 14 November 25 to 4th June, it was 15 months. From 5th June to 30th September 26, it will be 9 months. And beyond that, it will be 15 months or 18 months. So, as I said, from 1st October 2026, regulations are changing. So, for future dates, you will always have 15 months का deadline. Now, what is it we are talking about? Is it from the invoice date? Is it from the declaration date? Is it from the EDPMS date? No. This 9 months start from the shipping date. Let's say, for example, we have shipped today. Your 9 months countdown will start today. It starts with the shipping bill date. This is very critical. Moving forward for understand now, of course, whenever there are exports, you will also have advances, and exporters do receive advances on certain kind of transactions. It is the responsibility of the exporter to ensure that goods are shipped within 3 years of the receipt of advance. It was 1 year earlier, but it has now been relaxed. So it is important that we ship those goods within 3 years. If not, we need to go to RBI either for compounding or for getting the extension. If what is the interest on advance? If is there any provision for that? Yeah, you can do that. There is around 1% plus LIBOR, which you can charge. A refund for unutilized advance. Now, if you are not able to, let's say, deliver within 3 years, and uh, there is a ask for refund of that advance beyond 3 years, there is a specific RBI approval which needs to be taken. So you try to understand what is happening here. Probably what is happening here is whenever money is going out, it is stricter. Whenever money is coming in, it is lenient. So refund of advance, it is stricter. You need to go directly to RBI and to show that, okay, we had agreed, this is the contract, we had agreed for this kind of export, but we could not do because of XYZ reasons. And this is the refund ask which is there. And there are no interest obligations, or this is the interest obligation with it. So you have to, explain it in much detailed way to the satisfaction of RBI to ensure that, this export refund gets paid. Now, in my experience, I have never seen this refund to be done or approved by RBI. So what to do in that case is also not known. I mean, we had a very typical situation of this where we were mandated to give advance, but there was no provision for doing it, and even RBI was not approving it. So we are still in that limbo of what to do because RBI has no answer for it. Uh, how about long duration contracts? So there are contracts which needs probably more than 3 years, 5 years, or 10 years of exports. So there are certain provisions for this, but there are also conditions under which this can be done. So AD Bank may ask you for your export track record. They may ask you for there are amount restrictions. They may ask for some progress payments from buyers. So these conditions AD banks can put up. A certain guideline has been given under directions for this, but a much more level of authority has been delegated to AD Bank to decide. AD Bank has to see the transaction from the angle of ED to see if this is really a bona fide transaction, and that's where they will allow you this kind of transaction. Uh, Now let's talk about some practical challenges. Let's say you have exported, but some amount has not been received. This could be, for any reason. There could be shortage of material. There could be a bad quality of material which is being given. Or maybe there is a genuine uh, buyer who cannot pay it. RBI says nothing doing. We have given a flat rate. You can write off by yourself up to 5% by yourself and report it to ED Bank. If you are a status holder exporter. Now, what is a status holder exporter? It is a DGFT certified exporter, which is and that certification is given by DGFT if you have some proven track record of export. So if you're a status holder exporter, you have 10% ka leeway. And 10% is given to AD also. That AD has also been given to approve the write-off. Now, what is this percentage? This percentage is not on the invoice value. This percentage is basically on the export proceeds which you have realized in the previous calendar year. Now, let's say, for example, I have exported in 2026 of, let's say, $100,000, and I want to write off up around $10,000 because of non-realization. AD Bank will ask me what was my realization in 2025, and on that only 10% has been allowed by AD, 5% by myself. So this is the condition for write-off. There could be a condition, there could be a situation where you need to actually reduce the value. Say, for example, there could be goods which have been lost in transit, or there could be there could be reduction in value because of negotiation. It could be anything supported by a proper valuation report, etc. So AD Bank has been given power to accept that reduction up to 25%. They can't go beyond that. So anything beyond that will need RBI's approval. So what happens if we are not able to do this? If we don't fall in any other category and we go to RBI, and even RBI is not able to do it. Again, we are in the limbo. We can't do anything. That transaction remains open, and even RBI doesn't know today of what decision needs to be taken on that. So later on, recently they have come up with a guideline of, let's say, of around rupees 10 lakh of write-offs, which can be done for such kind of transactions. Now, if you fall into that 10 lakh bucket is another question. But if you don't fall it, then again, what to do? We're not aware of that. So whose responsibility is this? Wherever, I mean, that's again not AD Bank's responsibility. All the penalties and provisions which come up because of this provision will come on the exporter himself. So again, that is how the rules are, and we have to abide by it. There could also be situation where we need to set off some amount. Say, for example, you have exported some goods to a party and you have imported certain goods or services from the same party. You may need to just set off the transaction without actually moving the funds. So again, that is possible, but there are certain conditions. Let's say, for example, goods can be set off only against goods and not against services. You can set off the payments against the same overseas buyer or its group entity, but not a third party. You can set off for the same calendar year, but not for another calendar year, and so on and so forth. There are another 8 to 10 conditions, but these are the critical ones. What if we are not allowed to set off? Then it's better that we actually do the payment and actually receive the money from across the border. That saves you from the entire caution listing and penalty provisions of RBI. Let's take a moment to understand whenever I speak about what is the penalty provisions. I think that is critical. The penalty provisions are straight. It is not given, clause by clause or provision by provision. The straight penalty is given of 3x of value. Say, let's say, for example, we have exported $100,000 worth of export and there is a violation. The penalty is up to $300,000. Of course, it is on the discretion of RBI, but it can go up to that. So that gives us the sense of criticality of this regulation. Going further on, what is the post-shipment mechanics that we need to consider? As soon as the exports are done, we need to ensure that EDF, bill of entry, and all that bill of lading and all that stuff is delivered to AD Bank within 21 days. That is our responsibility, and our 9 months or 15 months timeline starts from the shipping bill date. In case of consignment exports, consignment exports are allowed from, you can do the consignment export, but your time trigger again starts from the day you have sent the consignment and not from the date of sale. So let's say, for example, you have sent a consignment from India to UAE, and UAE you have an agent who's going to sell it into the market. Probably he takes, let's say, 8 to 10 months for selling further. You are straight into the violation because your 9 months timeline starts from the day the consignment went from India to UAE. However, for overseas warehouses, let's say, for example, you have a warehouse outside India in UAE and you have sent it to the warehouse. Of course, these warehouse needs to be registered separately and there are certain conditions for that. But if you have exported to the warehouse and warehouse is going to sell it from there, your 9 months timeline will start from the date of sale and not from the date of export from India. So that's how about documents. There could be a situation where you need to change the buyer. You have sent the material, but the buyer is changed because of certain reasons. Could be a restructuring or could be any other structure which the buyer is following. In that case, AD has the power to permit it, but the reduction in value cannot go beyond 25%, which we discussed earlier. Now that was for the regular trade. Let's talk about the trade which are special. Something like project exports, which are governed by a specific memorandum of instruction and on P and PM, which we called it as PM 2014. It gets repealed from 1st October 2026, but as of now it's there. There are certain specific conditions given for these project exports, and we need to adhere to that timeline. These timelines and these regulations will override the import and export master directions. Similarly, for counter trade or barter trades, there are certain kind of conditions which are given under master directions, which says that if you are into barter trade where money is not going to actually move, you need to ensure that you create a escrow account because of any change in valuation, and the valuation needs to be conducted as per international practices. That is another condition for counter trade. For e-commerce exports, export of goods or services are allowed up to USD 10,000, and there is a specific guideline which is payment aggregator cross-border regime, which is going to come up, which is already there, but it's going to be enhanced in October 2026 again. And these exports needs to be aligned with those guidelines. Again, as I said, INR invoicing is being promoted. India is promoting to start cross-border transactions at INR rather than freely convertible currency. So that's why they are promoting to say that INR invoicing will be given 18 months instead of 15 months timeline. So that's how flexibility is being given for us for INR invoicing, and to ensure that India progresses on that front. Coming to import, reverse is the situation, but as I said, exports involves receipt of payments and import involves payment outside India. Receipts are stricter, but payments outside India are a bit lenient. So whenever you have any kind of imports done, you need to ensure that payment is done within 6 months. But there are multiple conditions and multiple level of leniency which is given to AD bank to extend that period of time. Let's say, for example, you have done any kind of import, payment needs to be done within 6 months, but ADA bank has been given power to extend it up to 3 years also. So that's how it is being given. And coming further, from 1st October 2026, even this 6 months timeline is going away. Your import payments needs to be made based on your contract. So whatever is written in the contract, you need to follow. So that's how the leniency is coming up for imports. Import of books doesn't have any timeline. AD bank, as I said, they can extend up to 3 years. Again, if there is any interest on this, it needs to be based on the trade credit rate. Similar is the case where we have advances for as we had advances for exports, we also have we may also have advances for imports, but things are a little stricter here. Whenever you are importing a goods, the advance that you can give is only up to $200,000 freely. When I say freely, it doesn't mean that you have to go to RBI for any amount beyond that, but you need to accompany the advance with a unconditional and irrevocable guarantee from an international bank. So whenever, if I have to give an advance of, let's say, $220,000 for any kind of import, it needs to be accompanied by a guarantee. Similar is for services. However, it's a little lenient here. Instead of 200, it is 500. For PSU and government department, it's $100,000. It's a little stricter for them. For aircraft and helicopters, it is USD 50 million. It is very high, but that's because it is governed by DGC as well, and the imports needs to adhere to those regulations provided by DGC as well. Similarly, for rough diamonds, there is no limit. For gold, silver, there is 11-day advance, and that is anyway going out from 1st October 2026. For gold and silver, you can't pay any advance going further. Now, what is the evidence of import and IDPMS mechanics? The way we had EDF and shipping bill for exports, there is something called as bill of entry that needs to be reported to AD Bank or given to AD Bank within the timeline. AD Bank needs to take care of it, ensure that it is reported into IDPMS, and any kind of advance, if it was given for the same for the same import, needs to be adjusted against it. There are certain relaxations given for listed companies or government companies for bill of entry perspective, where the bill of entry is for amount less than USD 1 million. Even the CEO or auditor certificate can work instead of bill of entry. For non-physical imports, something like we have Softex in exports, but for imports we don't have anything like that. So a chartered accountant certificate of receipt uh, is what works for the purpose of IDPMS mechanics. So how does it work from the IDPMS perspective? Whenever a money is gone out from India as an advance for import, AD Bank needs to create that entry into IDPMS. That's called as ORM. That ORM is for all kind of outward import remittance. Now, once the bill of entry comes in, they can set it off against that ORM. One ORM can be set off against multiple bill of entries and vice versa. Here again, there is a write-off of 5% of invoice value which is allowed. And AD Bank has been given the responsibility to follow it up every 3 months and rigorous follow-up after 6 months to ensure that things are in place. Any delay beyond this goes straight to RBI as a reporting. Moving further for gold, silver, and precious metals, there are certain nominated people who can only import gold. It's like nominated banks or nominated agencies. You can only import it through IFSC or GIFT City approved exchange mechanism, and there are certain credit periods which are given there. However, this entire thing is getting reversed from 1st October 2026, where this advance is completely prohibited. There is a specific 90 days credit cap which is given for gold imports, and other there are certain other regulations which are you would have read in news how gold, silver, and precious metals needs to be regulated. Those regulations are coming in place from 1st October 2026. Moving on to merchant trade. So this is a typical scenario which is not a complete export and not a import, or we may call it a half export and half import, wherein let's say for example you have agreed to export some goods to Germany, but the material is coming to you or the goods are coming to you from China, and you tell, okay, let's get this shipped directly from China to Germany, and the goods doesn't ever come into Indian borders. So that is what is called as merchanting trade, where goods doesn't come into the Indian borders, but it goes from your supplier to your customer directly. Now, what are the regulations here? There is a strict regulation of 9 months under which this entire transaction needs to be completed. There is a condition that the import payment needs to be done within 6 months, the import leg of the transaction. It needs to also ensure that this trade is, profitable for us. So you can't buy for 100 and sell for 80. You can always go ulta. It has to be a profitable transaction, and we need to demonstrate it to the AD Bank and RBI that it's a profitable transaction. Again, third-party payments are not allowed on either leg. And so that's how it works. Any kind of default in this takes you again to caution listing. Now, this is also changing from 1st October 2026 in a sense that this profitability condition is going out and third-party payments are being considered as allowable. But I suspect that this leniency will come with a lot of baggage for us, because AD banks will now do a strict vigilance on these kind of transactions. Wherever AD banks being AD banks, because they are given the responsibility to handle the entire bona fides of the transaction, it is important for them to understand if it is actually profitable or not. Even if that condition is gone, I suspect that AD banks will get into the profitability of the transaction and ensure that the reasons are recorded and are genuine. So I think relaxations will come with a strict evaluation criteria. Moving on to third-party import payments. So third-party payment for imports are allowed, and there are certain conditions for it that that third party needs to be part of your purchase order, needs to be part of the documentation, there has to be a tripartite agreement in place. The invoice must contain that narration, the bill of entry must contain the name. So there are a lot of challenges in doing this. We generally suggest to not do it because uh, typically this goes into a detailed level of scrutiny at AD bank level. But if there has to be, but if it is required to be done, it can be done. So there is a provision for this for bona fide transactions. Then there are certain ancillary facilities like import factoring. AD banks may allow factoring, wherein you are importing and that financing of that import leg can be done by AD bank. Now this is given completely at the AD's discretion. If they want to, they do have their internal policy. They do the credit checks and then allow it. Similar is for e-commerce imports, wherein up to USD 2000 per transaction has been provided through approved payment gateways. So I think there were a lot of case studies, but I think we can discuss it separately, considering the paucity of time. But I can at least tell you a heading of what kind of case studies we were about to discuss. Case study one was for, let's say, bill of entry never reached the AD. So we did the transaction, but bill of entry did not reach the AD. Now the transaction is complete, 6 months timeline is complete. We are within the well corners of law, but the bill of entry did not reach the AD, and that's why it got flagged into IDPMS, and that's why into caution listing. So you can't do anything about it, but RBI, you have to go to RBI and get it compounded. Second was export shipped and buyer did pay late. Now, this is not a transaction doer's responsibility to ensure, that buyer is not, um, you know, able to make payment, or he is probably not in that financial position. But there could be a situations where, buyer does pay late or buyer doesn't pay at all. But still, it's the responsibility of the exporter to ensure that the payment is in time. There could be situations where there are rate difference after the export is done. So this we had discussed earlier. We can do up to 25% of the reduction is allowed, and balance you can structure it in the form of write-off. But anything that goes beyond this percentage, probably will need RBI intervention again. Merchanting trade, similarly, as we discussed, there are certain conditions for that, and if you don't comply to it, you again get into caution listing. Netting of export receivables against import payables, as we discussed. Goods and services cannot be set off. Let's say, for example, you have done export of goods and an import of service. You can't set it off right now. But going forward from 1st October 2026, that leniency is coming in. Advance received an order cancelled, paid within 3 years. If not, that again goes to RBI for their critical check. Advance paid for imports and supplier defaults, and again nothing is shipped. So here again, this needs to be taken up with RBI. Probably a case which is filed against the supplier or a legal suit taken could help. But we have seen RBI taking funny stands on these kind of situations. So it is again very difficult to ensure this, and that's why we try to ensure that supplier check is done, vendor DD is done properly. We have all the DNB reports and all in place to ensure that the supplier is genuine, and we receive the material for which the advance is being paid. Moving on to trading for services, similar to what export for goods is, again, but for services, only for software, there is a declaration in form of Softex, but services are completely out of the picture. There is no special reporting for services. However, whenever the payment is coming in or the payment is going out for services, that gets flagged into the EDPMS and IDPMS, and that needs to be again set it off by providing all the agreements or contracts relating to those services to the AD bank. This needs to be ensured because, from goods perspective, at least there are multiple parties and documentation involved, and that's why people generally ensure that the reporting is done properly, but services are completely out of the radar. So we need to ensure that any kind of services are reported. Again, moving on to software, again we discussed for Softex. So what is happening on 1st October 2026? This entire regime is changing. All the import directions, export directions, these all are getting replaced by a new regime. Of course, more or less the spirit remains the same, but there are certain relaxations for what banks or RBI wants us to promote those kind of transactions, and there are certain restrictions on how people have been doing the transactions, which are causing impact on the RBI's balance of payments. So that is coming up from 1st October 2026. What are the critical changes? Let's discuss this one by one. As we saw, for goods, there is a export declaration form. For software, there is Softex. For service, there is nothing. But from 1st October 2026, we will have a single export declaration form, which needs to be filed within 30 days of month end. That will include everything from goods, software, service, etc. Everything. Export realization, which was up 9 months till today, it is going to be 15 months and 18 months if it is a INR invoice. So again, that realization and that relaxation is coming up for exports. For warehouse exports, as we discussed, it was 15 months from shipment. Now it is coming to 15 months from date of sale. For import payments, payments needs to be done from 6 months from shipment as on today. But from 1st October 2026, that relaxation is coming up where the statutory timeline is going out and the payment needs to be done based on the contractual terms. Set off of export against import, that set off was not allowable between goods and services inter se, which is now being relaxed, and goods and services also can be set off against each other. As we discussed, there were certain relaxations which had come up for small value entries of up to rupees 10 lakhs, where you can just declare and declare and tell that these transactions have been closed. Now that will come specifically into the 1st October 2026 directions. For merchant trade, there was a profit mandatory. It was mandatory for a profitable transaction. That test is now going out in 1st October 2026. Gold and silver, as I said, that advance of 11 days was there, which is now going out. No advance is permitted now, and a 90 days credit cap is provided. For defaults, earlier it was caution listing and IDPMS follow-up, but now this is important. These defaults will now be handled by AD Bank much more than RBI from 1st October 2026, and AD Bank has to resolve it on their own. Whenever there is something which cannot be resolved based on their internal policy, that will go to RBI, and there is a specific Pravaha portal which has been released by RBI for these kind of references. So goods of software and services coming into single EDF. This we discussed. I'll jump on to what we need to do till October 2026. Let's start, we being a consulting, either be a consulting professional or a service professional. Let's start regularizing our stock. Let's start closing the open EDPMS and IDPMS entries. Let's regularize the calendar wherever there are shipments, there are delayed payments, wherever there are no payments. Let's try to get an extension from AD banks and RBI wherever required and get that documentation in place. As we spoke, that import payments now will be based on the contractual terms and not 6 months. Let's redesign whatever import payment terms are there in our long-term supply agreements or import agreements which are already in place. Try to engage with the AD bank prior to the transaction so that we don't see any kind of surprises going forward, because from 1st October 2026, a lot of AD banks will have their own policy, and AD banks may treat you and another importer in the different manner rather than being on the same terms, because a lot of delegation is not now being given to AD banks. Again, replan the structures wherever we have set the structures of consignment models or warehouse models. Let's set that straight again, considering the 1st October 2026 regulations. So some key takeaways. Now these are based on our experience in handling these kind of transactions, and whenever we represent our clients to to ED and RBI. So first is never assume permissibility. Whenever it is specifically written, then only it is permitted. Otherwise, it is not. Even if it is a current account transaction, the transaction may be permitted, but there could be some distinction in the manner in which it is being conducted. Let's not assume anything. If it is specifically written, let's do that. If not, then let's approach AD Bank and indirectly to RBI to ensure that the transaction is legal. Uh, Wherever forex is coming in, the regulations are lenient. Wherever the forex is going out, it is stricter. Third, AD Bank is going to be a first regulator, so we have to choose it wisely. They'll have their own set of policies which are going to govern from 1st October 2026. So it is important to review all policies of your AD banks and see how are they going to treat us moving forward. Fourth, we need to design to minimize the set off or netting dependency. Try to structure the transactions in a way that set offs are not required or netting off is not required. Gross transactions are always clean. Let's go that way. Fifth, try to ensure EDPMS, IDPMS hygiene. We have seen a lot of AD banks reporting straight away to RBI and RBI taking actions on them through ED. Let's ensure that EDPMS, IDPMS is correctly reported every 3 months. Let's try to document everything. Let's try to compound early. Whenever required, go for extension. Whenever required for compounding, go suo moto rather than ED coming to us. ED coming to us is always a 3 times penalty. Whereas if we go and document by ourselves and go for compounding ourselves, it is very lenient in that way. We had seen a very typical scenario here where an individual had made an investment in a company in Singapore, and there were certain violations which we did not go by ourselves, but we did wait for RBI or AD Bank to find out. We got ED notice, and then we had to completely liquidate that investment. We had to close that company completely. ED did not allow us to even sell the business or do anything. They were We were mandated to sell all the assets in scrap and then get the money back. So that's how troublesome it was. Seventh, let's try to maintain the counterparty credit reports. There are agencies like Dun and Bradstreet who ensure that the suppliers or the customers for outside India are uh, are bona fide or are are compliant entities. Let's ensure that we have those credit reports in hand. And lastly, which is a very important, there is a reporting under financial statements wherever any kind of violations or contraventions affect or materially affect the financial statements, that needs to be reported. Since the penalties in FEMA are 3x of the amounts, I think these are material, and as a auditor or as a professional, we need to ensure that these are reported well. So these are few key takeaways which we found are critical for us to understand while we practice FEMA and face it. So that's it for today. I mean, happy to have any questions. If Shubham and Abhijit allow us some time.
Yes,
Otherwise,
yes,
we
yes.
can discuss separately also on emails, whichever.
Yeah, thank you so much, sir. I think there are few queries in the chat box, sir. Shall we take one by one those queries?
Yeah, okay. So that's this presentation.
Yes, shall I read it for you, sir, or are you reading it?
No, no, you can read. So that I think all of us are aware.
So the first query I think is material sent from X country, but due to way bill country mentioned as Y country. So bank denying to pay to supplier in X country.
Material sent from X country, but due to variable country mentioned as Y country. So bank denying to pay to supplier in X country. Yeah, so that is the exact issue in case of, third party payments. These needs to be reported in all your import or export documentation. If it is not reported well, banks will always not allow it. Uh, what you can probably do is get into agreement with that and ensure that that is reported again with the banks to ensure that payment is done forward.
Okay, so I think next is mold case. That is, I think mold will not be imported physically but need to pay as it is creating material as per our purchase order. How to pay? So I think mold is not coming to the country, it is being
Hmm.
purchased and kept somewhere for production. I think that is the query.
Yeah, so it's not actually your import, because till the time it is not physically coming crossing the border of India, it's not an import. Now, how do you pay for it is another question. Can you think of a service level contract for that, or can you think of a contract which is, you have to structure it in a way that it qualifies under service, so that I mean that's how typically everyone does, and that is legally permissible with RBI as well. That any kind of transactions where you can structure it in a way that it is service, then you can probably get through this.
Shall we take more queries, sir?
Yeah, I'm okay unless you have time.
Yes, so I think the Kedar sir has asked one more query. Sample material BOE cleared as payable payment term. How to get bill of entry copy for write-off?
Sample material bill of entry cleared as payable. Sample material bill of entry cleared as payable payment term. How to get bill of entry copy for write-off? Sorry, I honestly did not get this question.
I also didn't got the query. So I'll take next one. In case
Yeah,
shipping bill generated contains details of third party only and no details of buyer, that is in case of material sent to third party and invoice generated in the name of buyer, how to clear EDPMS entry? In the agreement, name of third party is not mentioned as there are many.
yeah. So again, this is a typical issue which generally people face since it is not, I mean, this is completely overlooked transaction where buyer and the third party is not mentioned in the entire documentation, and I'm sure AD Bank will not allow this. So you'll have to get that documentation in place first, have that agreement, get those declarations from third party as well as the buyer, uh, kind of sign a tripartite agreement and then approach bank again.
Okay. Yes, I'll take last query from Rahul sir. A manufacturer based in India has received goods supply order from overseas customer. There are three issues. Please explain on that. Invoice raised for producing trials and sending it locally to another party for testing. Goods were never shipped out of India.
Yeah. So since goods are being not shipped out of India, it doesn't qualify as export. You need to again structure it in a way that it's a service, and for that you are receiving the money.
Okay. Okay. Second one is invoice raised for preparing molds, tools, and these things are kept here in India only for the purpose of carrying out manufacture. These machines, tools, molds not sent out of India anytime, but remain property of the overseas buyer. So exactly opposite what we discussed.
Yeah,
Yes.
exactly. Same thing. Correct.
Okay. Third one, certain goods might be captively consumed or supplied to another party in India only as per the instructions of the buyer. Again, no physical exports.
Yeah. So till the time goods are not moving inside or outside the country, you will never qualify as for import or export of goods. Now, the issue remains that, even if goods are not moving out, but the money is. So there, people structure the transaction in the manner that it's a service, and that's how they get the transaction done. So that's how it works. The other way, which is a difficult path or the most straight path to do, is to ask the third party to create their presence here in India and do the transaction. But it's a difficult thing to ask from commercial expediency perspective. So I think getting that transaction structured as a service is the only solution for this.
Okay, sir. Fine. I think we are done with the queries also. So thank you so much, sir. I know the topic was something which is not in our day-to-day practice for all the chartered accountants, but definitely it would be, you can say, a starting point for all of us. And thank you very much for updating. And I hope we could have many more such sessions. Thank you for giving your time.
Thank you so much, Abhi. Happy to,
Yes.
take on uh, specific and more detailed provisions. I think this was a very big topic, and we can't go much deeper into this because of the paucity of time. But happy to break down this into smaller parts and then try to talk about it.
Yes. Thank you. Thank you so much,
Look
sir.
forward to it.
Yes,
Thank
sir.
you.
Thank you. Thank you. Okay. Good day.
Thank you, sir.
Thank you, Shubham.